Profit warnings surge as UK companies face a perfect storm of global uncertainty. UK-listed companies have issued a record level of profit warnings in the second quarter, according to the latest research from EY. Almost half of firms flagged policy change and geopolitical uncertainty as a leading factor. And as earnings season ramps up in the coming weeks, there's no sign of a trading picture becoming clearer. So, should investors still buy British? Jamie Lindsay is an investment analyst at Artemis. So Jamie, should investors be pessimistic about the performance of UK companies this earnings season?
So Peter, as you mentioned, we are in a period of extremely heightened geopolitical uncertainty with wars, with trade disputes, and we've already seen a reasonably large number of UK companies and some very large US companies react poorly to the Q2 results that they have printed. Our view is that if you are going to look purely at a single quarter, there are many reasons to be cautious in Q2, and we might expect many companies to have a reasonably conservative outlook. However, the UK economy and the UK stock market continues to have many high-quality businesses, and with a longer-term time horizon, there are still many reasons to be optimistic.
Let's look at Lloyds Bank. They're due to report tomorrow morning their first half results, and the company is facing operational headwinds. What are you expecting?
Lloyds, alongside the other UK banks, have benefited tremendously over the last few years from the higher interest rates than we saw in the previous decade. And at the moment, the economic outlook probably implies that we're going to have higher rates for longer. So our view is that Lloyds, not just tomorrow, but over the next few years, should continue to report solid results. Overall, however, the main upcoming catalyst for Lloyds is the Supreme Court's judgment on the UK motor finance, which is expected before the end of the month. And that is likely to be pretty important because currently Lloyds have had a provision of about £1 billion, and consensus estimates are expecting an additional £1 billion of impairments or provisions if there were to be a negative outturn from the Supreme Court, which in total equates to around 5% of the market capitalisation.
Meanwhile, UK food inflation has nudged higher and shoppers are starting to feel the burden of bigger grocery bills. Will retailers and supermarkets be hit hard?
The rule of thumb that we use is that when food inflation is above 5%, you start to see an accelerated rate of trading down. So we could be near a critical juncture in that regard. However, from a stock market perspective, we think that the combination of higher inflation plus a higher cost of capital for businesses given higher interest rates means you're going to see a greater dispersion in performance between the best supermarkets and the worst ones. And that plays out in the Kantar data where you see Tesco's gaining meaningful share, 86 basis points over the last 4 weeks, and some of their weaker competitors, Asda and Morrison's, losing share.
UK borrowing is surging meanwhile, raising fresh questions about potential tax hikes. So will this weigh on UK companies' outlooks?
When we speak to UK companies, time and time again, what they want is a stable tax and fiscal outlook, because that enables them to make long-term investment decisions that will benefit the UK economy. The likely tax hikes later in the year are a combination of fiscal prudence and weaker economic growth. And we do expect that that will have a negative impact on the economy. However, the most likely touted tax increases are going to be probably the freezing of the personal income thresholds, as well as potential capital gains and potentially even a wealth tax, which is being talked about. We believe that those are unlikely to affect the investment plans of UK businesses, but given the uncertainty, they are likely to be more cautious on balance.
So overall, Jamie, rewards for UK stock investors have been underwhelming, with advances quite meagre compared to benchmarks across Europe. So what's it going to take for the FTSE to catch up?
In our view, a lot of the strength in Europe has been down to flows of capital which were previously going to the US moving into Europe, and because of the massive fiscal stimulus and economic stimulus of higher defence spending on the continent. Now, we see no reason why those things shouldn't also be the case in the UK. But one important difference is that the flows of capital are not being directed towards the UK domestically. For example, we've seen an announcement that pension funds will have required allocations to UK private assets, but there is no equivalent allocation to the public markets. And we can take another example where there was a talk of UK ISAs having to direct capital towards UK businesses. At the moment, we have a system where the UK government gives a tax break to a pool of capital which predominantly flows into the USA. And we wouldn't think it's unfair if that tax break required some commensurate allocation to the UK to support UK businesses. And we think that with a greater level of government policy directing UK capital towards the domestic stock market, that would be a meaningful catalyst to drive valuations and performance in the UK to be similar to those of Europe.
That was Lindsay of Artemis. Don't forget, you can watch more videos on Reuters.com.